studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
One of the most valuable lessons in family tax planning is that equal treatment does not always mean identical treatment. Many people assume that if both spouses are involved in the business, they should automatically receive the same type of compensation. However, professional tax planning takes a different approach. Instead of asking whether both spouses should receive the same compensation, advisors ask a more important question. What type of compensation best supports each spouse's individual goals? This slide introduces that concept. On the left side, we have Spouse A. This spouse is focused on long-term financial security. Their priorities include CPP participation, RRSP contribution room, retirement planning, and perhaps qualifying for future financing, such as a mortgage. For someone with these objectives, salary may be particularly attractive because salary creates CPP contributions and generates RRSP room. On the right side, we have Spouse B. This spouse has a different set of priorities. They may value simplicity, cash flow flexibility, investment opportunities, or greater control over how income is received. For someone with these objectives, dividends may be a more attractive form of compensation. Notice what is happening here. Neither spouse is wrong. Neither objective is better. They simply have different financial priorities. And that is exactly why personalized tax planning matters. In the center of the slide, we see the advisor meeting with the family. This represents the role of a professional tax planner. The advisor's job is not to force everyone into the same solution. The advisor's job is to understand each person's goals and then design a compensation strategy that aligns with those goals. This is a major shift from basic tax preparation. A tax preparer focuses on reporting what happened. A tax planner focuses on creating a strategy that supports future objectives. That strategy may include salary for one spouse and dividends for the other. It may involve different retirement plans. It may involve different cash flow requirements. And it may involve different levels of participation in the business. The key point is that compensation planning should reflect the realities of the family rather than applying a one-size-fits-all approach. This is why the message at the bottom of the slide is so important. Good tax planning is personalized. Not everyone needs the same solution. As we continue through this scenario, we'll see how advisors can combine different compensation methods within the same family, and why that flexibility can sometimes create better overall outcomes than treating both spouses exactly the same. Now let's look at one of the most practical family compensation strategies used in real-world tax planning. Instead of giving both spouses the same type of compensation, the corporation uses a customized approach. One spouse receives salary, while the other receives dividends. At first, this may seem unusual. Why would two spouses involved in the same business receive different forms of compensation? The answer comes back to the principle we introduced in the previous slide. Different people often have different financial goals. Let's start with spouse A on the left side of the slide. This spouse receives salary from the corporation. Salary creates several important benefits. First, it generates CPP contributions, which help build future CPP retirement benefits. Second, it creates RRSP contribution room, providing additional retirement planning opportunities. Third, salary creates employment income, which can be beneficial when applying for mortgages or other forms of financing. And finally, salary contributes to long-term pension growth and retirement security. For someone focused on building retirement assets and maintaining employment income, salary can be an excellent fit. Now let's look at spouse B on the right side of the slide. this spouse receives dividends instead of salary. One benefit of dividends is that there are no CPP contributions required. This can simplify the compensation structure and reduce payroll-related administration. Dividends also provide flexibility. The timing and amount of dividend payments can often be adjusted based on the family's needs and planning objectives. In addition, dividend income may align well with certain investment strategies or personal financial goals. Notice what is happening here. The corporation is not choosing salary or dividends. It is choosing both, but it is applying them differently based on the needs of each spouse. This is what professional tax planners mean when they talk about a customized strategy. The puzzle pieces in the center of the slide illustrate this perfectly. Salary and dividends are not competing strategies. They are planning tools. And just like tools in a toolbox, different tools are useful for different situations. The goal is to assemble the right combination for the family. That is why the message at the bottom of the slide is so important. Different goals can justify different compensation types. Professional advisors do not start with the question, should everyone receive salary? And they do not start with the question, should everyone receive dividends? Instead, they ask, what compensation structure best supports the goals of each family member? Once you begin thinking that way, compensation planning becomes far more flexible and far more valuable. The objective is not equality for the sake of equality. The objective is creating the strongest overall family plan possible. This slide brings together the most important lesson from this entire scenario. Professional tax planning is not about making everyone receive the same type of compensation. It is about creating the best overall outcome for the family. Many people naturally assume that fairness means identical treatment. If both spouses are involved in the business, they assume both should receive salary or both should receive dividends. That approach can certainly work in some situations, and as shown on the left side of the slide, it has the advantage of being simple. Both spouses receive salary, or both spouses receive dividends. The structure is easy to understand and easy to administer. However, there is a potential problem. Simple does not always mean optimal. When both spouses receive exactly the same type of compensation, the strategy may fail to reflect their individual goals, responsibilities, and financial priorities. This is where customized compensation planning becomes valuable. On the right side of the slide, we see a more tailored approach. One spouse receives salary because salary supports CPP participation, RRSP room creation, employment income, and retirement planning objectives. The other spouse receives dividends because dividends provide flexibility, simpler administration, and support different cash flow or investment goals. Notice that neither compensation type is being treated as superior. Instead, each compensation method is being matched to the person who benefits most from it. This is exactly how professional advisors think. Rather than asking, which compensation type is best, they ask, which compensation type is best for this person? The family planning dashboard in the center of the slide illustrates why this approach is so powerful. Every planning decision affects multiple areas simultaneously. Corporate tax interacts with personal tax. CPP affects retirement planning. RRSP opportunities influence future wealth accumulation. Cash flow impacts family goals. And all of these pieces are connected. When advisors evaluate compensation strategies, they are not looking at isolated decisions. They are looking at the entire family planning picture. That is why the advisor's message near the bottom of the slide is so important. Let's optimize the family, not just the individual. This mindset separates professional planning from basic tax calculations. The objective is not to maximize one person's benefit at the expense of the other. The objective is to design a coordinated strategy that supports the family's collective goals. Notice some of the planning benefits highlighted on the slide. A customized approach may support different retirement objectives, different cash flow needs, greater tax flexibility, family-wide optimization, and better alignment with each person's financial priorities. These benefits often become more important as a family's financial situation becomes more complex. And that leads us to the key takeaway from this entire scenario. The best family tax plan is often not equal. It's appropriate. Appropriate means matching compensation to the individual's role, goals, and circumstances. When advisors stop trying to make every family member fit into the same box and instead build a customized strategy for each person, they often uncover planning opportunities that would otherwise be missed. That is the essence of advanced family compensation planning.